Recall that in 2008, many experts, including Indian experts, including someone I hold in high esteem, Dr. Y.V. Reddy, the then governor of the Reserve Bank, did warn, saying that what you're creating now is a lot of money in your system, and money has to flow somewhere, money has to follow yield. You don't have yields today because your interest rates. You see, why did you do quantitative easing? You dropped interest rates to virtually zero, and you found that even at practically zero interest rates, investment and employment generation was not taking place, and therefore you wanted to give a further stimulus, and that was the reason why you pumped more money into the system. And if there were no yields, and money always follows yields, they said it is going to lead to a huge inflow into emerging markets. And when you turn the tap off, or when you decide to reverse, we will again be hit when all of it comes back. So this was something which was foreseen. And why the crisis? Why the financial crisis? And why did we have that issue with Lehman Brothers at that point? Because we thought we had conquered risk, because we thought that by deregulating the financial sector, particularly in the United States, you had made sure that you had enough answers to the handling of financial risk and no accident can take place. And eventually, when you look back, it was very small. I mean, the whole issue was fairly small. What you had were basically structured products. Let me take you back 5 years. Subprime was an unknown word at that point. And what was it essentially? It was essentially lending to risky customers. Even that is fine. You can lend to risky customers. Everyone deserves money. And if you're willing to pay the price in terms of higher interest rates, it's perfectly fine. But then what you did was you created synthetic products. By an example of financial engineering, bright young things like you went into the financial institutions and created these products, and you never knew, and you thought that you were actually diffusing risk, you thought that you were mitigating risk, you were reducing risk and spreading it across so that more people can bear it. But in effect, you created a system where nobody knew where the risk stood, and nobody knew where the risk was housed. And once trust breaks, the whole thing comes crumbling down, because all that people knew was that somewhere in the structured product, there were perhaps 2 or 3 loans which were subprime mortgages, and since the US housing market had an artificial boom due to low interest rates, and now the prices of houses were going to come down, there were people who would be unable to repay these loans, and nobody knew in one synthetic or structured product what proportion was a subprime mortgage and what proportion was a regular safe mortgage. Just that uncertainty was enough to make sure that firms which were over-leveraged in terms of these structured products, and I remember the other famous term was CDS, collateralized debt securities, similarly risky products which were sort of split up and across in different firms, led to a situation where other firms were unwilling to lend to Lehman Brothers, and overnight the money dried up, and overnight the whole thing came crashing down. The same thing when it was about to happen to AIG, they pumped in something in those days like $180 billion. Imagine what that size is. Much larger than the GDP of many, many countries. The World Bank, by contrast, possibly lends about $25 to $30 billion a year. To a country like India, official borrowings are about $5 to $10 billion a year. And that's what was given to bail out AIG, the American insurance group, in that year. And all of that was done fundamentally because you did not want the financial market, you did not want the entire edifice of global finance to come crashing down. So what do? Do you then go back and then say that, no, we don't want any of these structures, we don't want to be globalized, we don't want to be linked, we don't want an efficient financial system? Do you close all that down? Or do you try and see what is it that you can do to reduce the volatility? And here I'd like to just join issue with Professor Lewis, just to say that possibly I think it's virtually impossible in this setup to kind of say that you will eliminate all crisis for good. History of crisis is not just 40 years, it's more than that. History of crisis is probably 800 years or 1,000 years, ever since trade and financial transactions have been taking place. We've had the 17th century crisis, we have had crisis before that, we've had economic crisis and financial crisis go hand in hand. The question really is, how do you ensure macro stability in the system at the level of the economy for a country like India? And in parallel, how do you ensure that small businesses and others insure themselves? And what do you make sure, or how do you make sure that you're able to survive through turbulent times? Part of it in a capitalist system, and willy-nilly we have ended up in a capitalist system, crisis is part of life. There will be downturns. There will be times when we'll make a lot of profit, which means a number of firms will enter the market because chasing those profits. And when the number exceeds what the market can bear, there will be a problem, there will be a shakeout, and firms will drop out. This happens all the time. It happens all the time with every kind of business, every kind of firm. And when technology changes, something else changes, people will go out of business. Video parlors were a big business 30 years ago when I was a college student. Do you see one today? Technology has changed and they've gone out of business. People have adapted. I'm sure most of you, when you walk down Sterling Road, I've noticed that restaurants seem to be closing down every 2 or 3 years and new restaurants open, right? Tastes change, the prospects of business change, and life changes. Finance is special in two ways. It underpins all other businesses, and therefore it connects up everything else that happens, and therefore it is critical and important to the way the economy functions. But at the same time, we should never forget that it shouldn't become an end in itself. It's a facilitator of other businesses. It's a facilitator of a way in which savings can be mobilized efficiently and allocated efficiently for real-world investment in other sectors where value is really generated. And all other products, financial products, whether it be insurance products, whether it be derivative products, whether it be hedges, whether it be swaps, whether it be any of these means, those are all primary. The primary intention is to mitigate risk, is to reduce risk, is to enable somebody to hedge their risks which are inherent in any financial transaction. Naturally, they have to be economically viable for people who are entering into it. Naturally, there have to be two counterparties. When I'm seeking to hedge my risk, there needs to be another person on the other side who's willing to absorb risk, and he needs to be paid something to do that. And there is a market price there. So what we need to be careful about to see that it functions or it performs the essential functions in the economy that it needs to. It needs to be efficient in doing it, and it needs to really feed into the real economy and not get divorced from the real economy and become an entity in itself and take on a life of its own, placing the real economy itself at risk. And which is why financial regulation becomes that much more important. And I think that's the hard lesson we learned from the global crisis of 2008, saying how do you more efficiently regulate the financial system? How do you more efficiently structure it in a way that you ensure that the financial sector stays regulated? We have, in today's context, and the regulation happens at multiple levels. It's a complex area. It happens for multiple products. and it happens for, today we recognize something called systemic stability and macroprudential regulation. We recognize, for instance, just to share personal experience, I joined the IMF in March of 2007, at a time when it was felt that the IMF had really no future. And I enjoyed myself. I went away from a very, very busy job in Delhi and prior to that as well, and it was a good welcome break. So from about March of 2007 to September 2007, I probably had the best time of my life. Went to work in the morning, 11 o'clock went and had a cup of coffee, 12 o'clock went to the gym, 1 o'clock went out to lunch, 3:30 went out to coffee, and went home at 5:30, which I had never done before or after. And then come September 2007, first you had Bear Stearns. People forget Bear Stearns when they talk about Lehman Brothers. Bear Stearns collapsed. And then, slowly at the same time, the Western countries were putting a lot of pressure on the IMF, saying that, you need to downsize, you need to, contract. And at that point, that was in late 2007 is when Dominique Strauss-Kahn, the infamous Dominique Strauss-Kahn, came and joined as the managing director of the IMF. And I actually recall this discussion where we were saying that the budget of the IMF needs to shrink, the staff need to shrink. And I recall having raised the issue saying, we do shrink, and what happens if there's a crisis tomorrow of some kind and you need all these experienced people back? And lo and behold, this was in December of 2007, and lo and behold, in March of 2008, you had Lehman Brothers and you had everyone running for cover. And the IMF was rediscovered, and we were in the business of raising money and in the business of getting back to trying to help countries. And the other big change was that for almost 30, 40 years, the IMF had only been advising Asian countries, advising Latin American countries, advising Eastern European countries on how to cut back on the fiscal deficits, how to balance their budgets, how to take the pain of exchange rate devaluations, and all of that. And life suddenly changed, and the people at the epicenter of this crisis were the European countries. And I had a very, very interesting conversation with the then finance minister in October of 2008. I recall, I asked him saying, sir, would you be prepared to lend to the IMF? Because we were sitting on reserves of $300 billion. So he kind of looked at me and said, what, borrow from the IMF? Never. So I said, no, I'm not asking you to borrow from the IMF. I'm saying, will you be prepared to lend to the IMF? And we lent eventually $10 billion along with the other BRICS countries. But again, you realize that life changes very quickly. We came pretty close to going back to the IMF to borrow again, as recently as a few months ago, in terms of thinking, or there was loud thinking in the media saying, do we need to borrow from the IMF? And why? Why do you need to do it? Because what you ultimately need are sound macroeconomic policies. Reverend Father Deputy Director said, we need sound macroeconomic policies, structural reforms, institutional reforms. Absolutely the prescription, something that I would wake up at any point and put it down on a piece of paper. Easier said than done. Easier said than done. Everybody in this room, let's recognize our stakes. We love to criticize governments saying that, you give away freebies, you do this, you do that. All of us extract a pound of flesh from the system. We just like to preach about what others extract. There are older people in this room, senior citizens. If I said that, we'll deregulate interest rates and small saving interest rates and public provident fund interest rates will come down, there will be an outcry. The Indian middle class will say, no. But, so those interest rates should be high, whereas if I have to borrow to buy a car or buy a motorcycle or buy something else, that has to be cheap. How does that work? You're all finance people. Can that work? Can I borrow at a higher rate and lend to you at a lower rate? So all of us have vested interests, and whenever you say structural reforms, you have to actually act against vested interests. And the most articulate vested interests are middle-class vested interests. And that's what you will see in pink papers, and that's what you will see in business channels, and that's what you will see all the time. So let's be realistic that, many of the structural reforms we seek, many of those reforms we seek, we have to be careful in terms of, what we articulate, and as responsible citizens and as responsible participants in the